Today I'm going to talk about how to get a high rate of return. And this video is specifically for people who want to invest and are looking at different rates of return. You need to know this math. I'm going to walk you through the math, what you need to know. If this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner with Sickle Hunter Financial Advisors. Okay, so I'm gonna throw this up on the screen. I put together a little spreadsheet in Google Sheets so I can walk you through the different ways to calculate a rate of return. The three that I'm gonna talk about are the annual, the average, and compounding. Now, if you're not a math whiz, don't worry about it, but I do wanna educate you. This is very important when you're looking at rates of return, that you're using the right metric. I wanna make sure that you're using the right metric, so stick with us, and I'm gonna walk you through an example right now. I'm gonna pull it up on the screen here. We're gonna look at an investment. We're just gonna look at the rates of return. So on this spreadsheet that we're looking at, you can see the years right here. We have 1, 2, and 3 years. Year 1, we got a 25% rate of return. Year 2, we got a negative 30%, so a terrible year. And year 3 was a positive 20% rate of return. Now, these are just 3 arbitrary rates of return for 3 separate years, so I can show you what that looks like. So we're gonna look at the average. So when you hear the word average, it's the wrong way to look at an investment. So we're looking at the average here. How do you find the average? All you're simply gonna do is add these 3 numbers up. So we'll take 25 plus negative 30 plus 20, and we're gonna get 15. Now, the way to find the average is you just simply divide by the amount of years, which is 3 years, equals our 5% rate of return, as you can see right here. So you see that's the average rate of return, but it's very misleading. Here's why. Look at the results here. Our initial investment was $10,000. Initial right there, $10,000. So over a 3-year period, it only grew to $10,500. Now, 5% of $10,000, that's $500 alone. So if someone said, I got an average rate of return of 5%, you'd probably would expect it to be more than $10,500 because it's really the wrong way to calculate the rate of return. The way to calculate this rate of return is you want to look at the compounding. Now I'm going to delete all this really quickly, and the compounding is right here. So the compound interest deals with what the initial investment is, what the rate of return is for the year, and then it looks at the ending balance and then does the same thing for the following year. So each and every year, if you have gains or losses, that's going to affect it moving forward. And you can see that it's completely transparent. It's a much better indicator when you're looking at compound interest or compound annual growth rate. So this is 1.64. Now, if you think a 1.64% annual rate of return or a compounded rate of return, you would understand that it's probably 10,500. So that's just one way of looking at it. But I want to flip it so we can look at what the average is if we actually got 5% each and every single year. So let's remember this number. 10,500 was our ending value, and 10,000 was the beginning. Okay, so now we have the 5% every single year rate of return. So when we have 5% every single year, the compound is actually the same. So it'll also be 5%. So both the average and the compound are the 5%. And as you can see here, 5% each and every single year. The results drastically different. So we have $11,576 now. That's over $1,000 more. And we got 5% every single year. So we had the same ending result of the same average, but the results were vastly different. So that should show you that the average rate of return is a really poor indicator of how well your investments do. So if you're at a cocktail party talking with some friends and they say, I got an average rate of return of 5%, you really have to question how well their investments really did. Okay, so now let's go back to the original example where we're getting 25% the first year, negative 30 the second year, and 20% our third year. And let's change one thing. What happens when investments do really well? People get really excited and they want to throw more money in those good investments. So let's do that. If we got a 25% rate of return, you're probably pretty excited. So you want to put more money in that investment. So let's look at this column right here in our contributions. So in the beginning of year 2, after we got our high rate of return of 25%, we're going to throw another $5,000 into this investment. So our total investment at that point, since it's grown to $12,500, is going to be $17,500. And you can see that right there. $17,500. Really excited. We put this money into the stock market or the S&P 500. Now let's see how well it does. Well, we had a terrible year that second year and negative 30. So we took that original investment of $15,000 and unfortunately it has decreased. But then it bounces back and we get a 20% rate of return. But when something doesn't do so well, what do we usually do? We don't invest more money. We do the complete opposite of what we're supposed to do. We look at the investment, see that it goes down, assume it's a poor investment. So that year we decide, listen, I don't want to do another $5,000. So we keep our original investment. So that ending balance is $14,700. Well, wait a second. Our total investment was 15 grand. But our average rate of return, 5%. So I don't know about you, but I wouldn't feel too great if someone said I got a 5% average rate of return and then handed me back less than with what I started with. That is not the way to look at a rate of return. Unfortunately, there's a lot of people who calculate it based on the average, and that's just extremely misleading. And as you can see with contributions and withdrawals, it could greatly impact your investing. And most, if not all, people invest periodically. So you're saving into your 401k over time or your Roth IRAs or any other type of investment account. You're putting a little bit away at a time. And that really impacts the end result quite a bit. So the question is it really possible to get a higher rate of return? Now the S&P 500 over from 1926 all the way up until 2015 had a compound annual growth rate of exactly 10%. So it's exactly at 10%. But any time frame in between is going to vary. So it's not always going to be 10%. So even though you hear the S&P 500 gets 10%, doesn't mean that you can go out and expect to get 10%. Sometimes you're going to do better. Sometimes you're going to do worse. And that's, again, if you're investing in the S&P 500. If you pick an index fund or enhanced index or an ETF, anything that's tracking the S&P 500, you're going to get relatively the same returns. We're talking mostly about the compound annual growth rates versus the average. So those are two very different ways of calculating it. I'm not going to go through the math on the compound annual growth rate. You need a financial calculator. It's the best way to do it, but it's way different in terms of results. So you need to look at those. But let's take a look at short-term and long-term investing for a second. Now, I've done other videos on this, but this is really interesting and important. If you look at, I'm looking at the S&P 500 rates of return on a spreadsheet I have here. In 1997, it did 33.4%. In 1998, it did 28.6%. In 1999, it did 21%. So if you were investing over that 3-year period, your confidence is growing quite a bit. And you think that, hey, if we can get 20+% every single year, I might as well go into the stock market at that point. Well, unfortunately, it didn't work out like that. I'm sure you know. In 2000, it did negative 9.1%. In 2001, negative 11.9%. And then in 2002, it was negative 22.1%. So 3 years in a row of negative rates of return on the S&P 500. But wait a second, I thought we got an average of 12% or 10%, depending on what math you're running. It's very different than the real rates of return that you're seeing each and every single year. So you have to understand the rates of return, how they're calculated. So the next time you're talking to a friend or hear somebody saying, I got a great rate of return, I got a rate of return that was higher than your rate of return, you need to make sure that the math is correct because there's a lot of different ways to calculate rates of return. These are only a few of them, but hopefully armed with this information, you can make a more informed decision and not get sideswiped by you can achieve a 12% rate of return and expect to get 12% each and every single year. It could happen if you have the right investments, but we're specifically talking about the S&P 500. We're not talking about our investment acumen or the greatest stock picker of all time. We're not talking about that. Looking at the S&P 500, it's the same investment with different rates calculated in different ways. So you really need to pay attention to that. If you have questions, put them at the bottom. I'll look at them, see what we can do to make more videos. If you found this video helpful, be sure to subscribe and leave your comments down at the bottom.